Hello, everyone. This panel is Maximizing Crypto Earnings with Decentralized Finance. We have a great team lined up that will be discussing this panel. First, we have Shane I. He's Head of Research and Development at ByBit. We have Anish Mohammed, who's going to be joining us shortly. He's co-founder of Panther Protocol. We have Piers Ridyard, CEO of Radix DLT. And we have Sergej Kunz, co-founder of 1inch Network, and we have Tilton, who is CEO and co-founder of SmartFi. So if everyone can kind of give their introduction, their involvement in the space, and also their level of interest or involvement in specifically maximizing crypto earnings with decentralized finance. And we could start with you, Shane.
All right, cool. Okay, hi everyone. My name is Shane. Currently, I head up R&D efforts for ByBit. So ByBit's basically, you can call it like one of the top derivatives exchanges in crypto right now globally. So mainly we focus on a perp swap product, but if you've been looking at what we've been doing, actually we've been launching a lot of new products this year as well. Right. So a big part of what I do is product design. Right, across both CeFi and DeFi, right? And also I cover overall research in the crypto space internally as well. So happy to be here. Yeah.
Great, thank you. What about you, Piers?
Sure. My name is Piers Ridyard. I'm the CEO of Radix. Radix is a layer 1 protocol built specifically to serve DeFi. We like to say it's layer 1 DeFi done right. We focus on three main things. One is 10xing developer productivity and building decentralized finance applications. Second is 100xing smart contract efficiency to increase the throughput of networks. And the third one is 1000x scalability when it comes to consensus. And these are basically just looking at the tools that make it possible for people to build more innovative DeFi products and get to market quicker. But we also built a bunch of services around that as well. So we have an API-based AML KYC product that allows DeFi developers to include AML KYC into their products so that they can also start to service the institutional market as well. So we spend a lot of time working with DeFi developers building decentralized finance products, basically.
That's awesome. Sergej, what about you?
So hi everyone, my name is Sergej. I'm co-founder of 1inch Network. Back in 2019, I invented together with Anton Bukov, my co-founder, on ETH New York hackathon in New York City, aggregation among decentralized exchanges to solve a huge problem in DeFi space. What was the distributed liquidity among several exchanges? You never got the best rate, so we just solved this problem by just using algorithms and splitting among DEXs. Right now, we are aggregating more than 65 liquidity sources on Ethereum, 30 on BSC, and about 16 on Polygon, and offer exchanging tokens in a decentralized manner by using aggregation protocol among multiple markets. So it's not just splitting, it's just going through multiple markets and one single transaction, fully secure and safe for the people. 1inch Network itself is not just an aggregation protocol, it's more. It is also limit order protocol, liquidity protocol. Every time when we release something, we solve additional problem in DeFi space. So we are here to grow the space to make it user friendly for the users. For example, our wallet is also kind of product to onboard new people. So my professional background, more than 15 years of software engineering architecture experience with business experience in aggregation and multiple startups, consulting services, Bosch, Siemens, Porsche, and so on.
Awesome, great. And lastly, Tilton, what about you?
Thank you. I'm CEO of SmartFi, which is an open lending platform. We have both a CeFi platform and a DeFi platform, interoperable DEX. And our history really started going on about 5 years ago in an odd way, where we originally are a 14-year-old company developing energy infrastructure. So we used to develop oil and gas pipelines, Also, we develop a new nuclear power plant site. So our background really is in energy, and we're experienced in the derivatives in the energy space. And as we started getting all these strange calls from cryptocurrency miners looking for large-scale power that were sometimes as large as powering a city, and wondered, what are these guys doing with all this power? And that was our introduction into crypto. And so we started helping develop these large-scale sites for mining. And when the market had a big correction in the latter half of 2017, early part of 2018, all the projects that we were working with, the miners said, "Hey, gosh, my crypto, used to be worth $20,000 in Bitcoin, and now it's down to like $3,000." So none of them had any money to keep moving on with their projects. So we decided to start lending them money. And from those beginnings, we started a platform and started lending money to cryptocurrency miners. And so our largest customers were actually in China. We were here in the United States. And from there, we started figuring out some of the things that we wanted to innovate in the space, came up with different algorithms and structures. My background 20 years ago, I worked for a software hardware company that built ASICs for interactive voice response. So the combination of my background in energy and in hardware led to our beginnings here in crypto, 5 years ago, and all of a sudden we became a cryptocurrency-backed lender and started working in the space.
Exciting. It's a great panel to have here discussing maximizing crypto earnings. So one of the first questions is, there's so much that one can do in terms of using decentralized finance. What are the best ways of maximizing your crypto? How do you get it to start working? Do you go more the traditional route? It seems like we've kind of have two different paths. One that is kind of the lower APY, which is far more secure, and then one that is kind of much more higher APY, which is really kind of almost taking the risk of these newer projects. How do you see yourselves in the space maximizing your crypto?
I mean, it depends what your risk profile is, as you say, but I also think it depends on whether or not you are sort of buying into the decentralized finance dream or not. A lot of what the promise of smart contracts is that you don't have to have a centralized intermediary to hold the security of the underlying money that's being placed with them. So like with a smart contract, I can put USDC in it, and then I can have a set of rules that I can audit that says whether or not that USDC can be used by someone else. So if you take something like Aave, which has over $10 billion worth of assets associated with it, the whole premise is that Aave, I'm not actually giving the money to Aave. I'm putting my money in a smart contract, and there is a market out there that wants to borrow my crypto. So if I've got USDC as stablecoin, and there's a bunch of traders who are trading across Uniswap, and they're trading across 1inch, and they're trading across other DEXs. They have a short-term funding requirement, and they will post collateral in the same smart contract for that, like wrapped Bitcoin or like Ethereum. And so there's real demand. You are doing the traditional thing that financial markets always used to do, which is matching long-term lenders, long-term credit with short-term borrowers. But we're doing it on top of a decentralized finance infrastructure. Now, yes, those smart contracts might get hacked, and yes, there are risks associated with it, but that yield is real. And you can actually audit it. You can say, okay, I can see that this set of traders is paying, 15%, 20% APY, 25% APY to be able to get exposure to go and arbitrage something on Uniswap. But as a lender, I don't care, because I know that my collateral is completely safe. However, even in the space of, centralized borrowing, where I can go to something like Celsius or BlockFi, it's a lot less transparent. I don't know who my money is being lent out to, and where the yield's actually coming from, and how trustworthy their balance sheet is, or anything like that. But they have their regs around them. And so, like, I think that the whole premise of decentralized finance is this disintermediation and this increase of transparency. If you believe in that, then go use decentralized finance properly. If you're just like, oh, I just want to know that if my money disappears, I've got someone I can knock on the door of and say, hey, like, my money's gone, then yeah, go with one of these centralized providers, because they both provide yield and their yields are quite close. So some of this is philosophical and some of this is also just like, how much money do I want to make?
So I would like to add from my side. So I would like just to share my experience. So I'm in DeFi since like 2018, I would say. So like late 2018. And I was playing around with a couple of products out there, like Curve. First days, I was one of the first guys who used that, and also provided my hard-earned money, I would say, to Curve, because I have seen the huge APY, and based on this actions I did in the beginning of this product, I got a really great airdrop. I was really surprised. I still get these tokens here, and this is great. Same with Gitcoin. So I personally we just used Gitcoin together with Anton, and we got really huge amount of money from Gitcoin, and this is new age what we see right now. Kind of times where everyone can build a great product and grow it to a really a huge one, and just to play around with some protocols. It makes sense, to get maybe like also from Uniswap I got some airdrop, but I agree also the people should take care and understand that not every smart contract is safe, not every project is decentralized. In terms of Aave, I can say that they have admin keys on Polygon. They plan for sure to all hand over to the governance, but also in the governance there are like 5 of 8 multi-sig, which can just decline every proposal. This is also insane. And if you don't get any support from the Aave team, you have no chance to list the token. For example, OneInch token is not listed on Aave because the team is not supporting them. So there are a couple of problems still there, but we are working on DeFi to improve that. That's from my side.
Yeah, I'm going to try and answer Nelson's question a bit more directly, I guess. I think one good point that he really mentioned was, yields are coming down, right? DeFi on the really safe stuff, right? You land on Aave, Compound, whatever, right? So I think what's really beautiful about DeFi that we see this year especially is that just a year ago, we had DeFi Summer 1.0, right? And that was kickstarted by Compound's liquidity mining, right? And it's come so far since then. Right. So nowadays, like, sure, you could go on like Curve and maybe you could get like a decent 10% yield, which is great by TradFi terms. But, like just like in TradFi, yields are getting more and more difficult to get because the people coming in are getting more and more sophisticated, right? They know how to get these yields better. So for example, nowadays we have, Uni V3, right? We have all sorts of different structures that you can build in DeFi. You have flash loans that you can actually use to amplify your mining return and so on and so forth, right? So I would say that DeFi is sort of following TradFi in the sense that the yields are just getting tougher, right? And it requires a certain amount of sophistication to continue getting like 20% APYs and beyond. Yep.
Yeah, maybe I'll chime in here. When you have a financial product that is still always built around trading as the core thesis around yield, trades come and go because as soon as everybody else figures out what the trade is, everybody gets on the other side of the trade to generate yield. And our experience in the energy markets has taught us a couple of things over the last 20 years. Is that when you have a trade, one, you don't talk about it, you engage in it, and two, once everybody else knows about the trade, the good side of the trade goes away, right? And certainly with yield farming or other strategies around DeFi, they're going to come and they're going to go. And the innovation around those trades are going to need to get more sophisticated, and they will, because wherever there's money, institutions will come. And so maximizing your yield has a lot to do with figuring out what the trade is, and then it's kind of a catch-22. If you know what the trade is and you don't say much about it, you don't promote it, then not many people are going to engage on either side. So going forward with DeFi, what we see is really the maturity of the space has got to be around broadening the base of the trade and engaging in structures that are typical and outside of just trading crypto. If this space doesn't evolve to something else and to engage the broader public and a broader base of structures, and where people start to specialize in certain types of trades because of the needs of the broader financial markets, it's always going to be a niche industry. The yields that you were seeing in the beginning of 1,000x, those kind of things, they were great for a small amount of people, but you need to have a mature space. Some of the things that we're doing is focusing on maturing that space. Most trades are not super complicated. They involve the leverage of knowledge and de-risk on one side, and then somebody else taking risk on the other side. That's the basis of a trade. And so we're structuring our products and the DeFi elements of what we're doing to broaden the market and include things that are not considered crypto specific. We're doing some structures around real estate. We're doing some other things around small business equipment, a broader economy application, so that we can help other people attract the capital that they need in regular kind of traditional business and engage crypto, so that on one side of the trade it involves crypto, but the people who are receiving the benefit of the lending part of the capital, they have no idea that crypto is involved. That's when you're able to replicate a trade, generate the yield, and it's something that you can repeat, and it has longevity. And so that's where we see the future of DeFi, and those yields are in really the traditional spaces, but you lever crypto, and when one side of the trade doesn't know that it's involved in crypto, you can keep your edge in your trade.
I was about to add something. I don't know, how everybody sees the crypto space, but if somebody has been around far too long, you probably notice for systems to be stable and to have a reasonable yield, you need to have a reasonable amount of regulation and a reasonable amount of transparency. One of the things that happens in DeFi is all the transactions, and one of the previous speakers was saying, all the transactions are private. So if I know for some reason that one of your wallet addresses, I could go to the graph, deploy a subgraph onto your smart contract address, and I could just replicate your trade. So literally the depth of the market disappears, which is generally not the case in traditional markets in that sense. See, most of the large hedge funds, for example, on Essence Technologies, you don't know what their strategy is. So there will be that arbitrage that will be happening. So unless the market, as Alan, as you were saying, unless the market widens and all the different assets that are there comes in, and they are accessible to everybody in a reasonable manner, as in like in a more democratized manner, it will still be, DeFi could still remain as a trade for a smaller subset of people getting higher yields. Otherwise, the yield curve will change the shape, and it will be a normal bell curve in that sense.
I'm not sure I agree with what you two have been saying. Like the provision of liquidity on Uniswap isn't something that someone sees the deal and then it goes away. You are providing liquidity to a market that requires facilitation, and every time someone trades across Uniswap or 1inch, they are paying the people who provide the liquidity for providing that liquidity and facilitating the market. That's a very common thing that happens in traditional financial markets, where you have liquidity providers and you have people who are coming to the market to trade between asset pairs. That is a long-term yield. It's not like that's going to disappear. It is something that you are facilitating markets for, and that's essentially what the underpinning of decentralized finance is. You could also talk about that from the point of view of Aave. You can also talk about it from the point of view of Curve or Compound or any of these things. And the point of regulations, and also an interesting one as well. Like I'm not sure why regulation would change or improve necessarily the provision of liquidity via something like Uniswap, or the provision of collateral via something like Aave.
Is it okay if I try to answer you, Piers? Just to make sure that you and I understand. As somebody who has been involved in building this thing for a long time and have worked in traditional markets, so depth of the market is very, very clear, right? And it is not, all blockchains we know don't work in lightning speed. We know Ethereum at whatever speed it works. So in my past, I've actually been part of the Ethereum Swarm team. So I know to a great degree, I've seen how it evolved and what's the speed it has. Given it's the current set of blockchains, given the depth of the market, if somebody were to just queue up the market, I could pretty much say to you that nothing would happen. And that is literally what depth of the market disappearance in one sense is. It's just a denial of the market space you have. In a traditional market, that is much more harder because the throughput is far higher. As simple as that.
Yeah, certainly true. Like the throughput's a problem on top of Ethereum. I don't disagree. It's why we built Radix, but I'm not sure that. Anyway, doesn't matter. I think the actual question was like, how does someone maximize their earnings in DeFi? Right?
Hey, let me read part of this question, because we're talking about maximizing the profits, right? The yield, and that's the core piece of what we look at is that correlation. So the correlation currently for DeFi markets is really built around trading crypto, right? It's levering up in the marketplace, you're looking for credit. You're going to go to some place like Radix or some other DeFi platform that allows you to lever up and to have an outsized return based on your current basis of capital. But the correlation is always around the crypto markets. And so when the crypto markets go up, they obviously come down as well, right? So the yield, depending on which side of the trade you're on, for some, the yield's going away. And what I'm talking about in terms of expanding the universe of capital into other markets that are uncorrelated with crypto, clearly that's going to give you the opportunity when crypto markets go down or the trades kind of go away or they're evolving. You have a section of the market that allows you to go into an uncorrelated asset that you can continue to use your crypto value to generate more yield. So a diversified credit issuance over time will definitely generate more yield than a single correlation or commodity base. We look at crypto as really it's commodity based because it's not currency as the world knows it. It's a commodity. We're involved in large scale mining all over the world, and I can tell you cryptocurrency is a commodity the way that it's developed. It's a derivative of a hash rate structure that's based on a electricity and silicon chips. So expanding beyond that commodity into something like equipment lending or commercial real estate, and where somebody's looking for credit in that space, you can maximize yield when the crypto markets might not be yielding much. That's how I think in the future of DeFi is you maximize yield by getting diversified and finding new trades.
And in terms of companies, projects, protocols that are facilitating maximizing your crypto earnings. We had Sergej talk about Curve. Curve, I think, is a great example of really a protocol that has been able to do that on a big and consistent basis. What other, or even Curve, what other projects are doing this that you guys are interested in and look?
I would like to start maybe. I like what Hayden Adams with his team released with the Uniswap v3. So it's not very flexible for market makers, but it's easy for normal people to play around. What is potentially dangerous as well. So, for example, I played around with Uniswap v3 and I deposited in like small price range Ethereum USDC and 1% fee. And as long the price is flattening, yeah, so it makes this, yeah, it's just goes up, goes down, goes up, goes down. You can generate 1% APY every day, yeah, as long as this is like flattening. If it goes down, you have a problem. If it goes up, you have potentially not a huge problem. Yeah, but I like Uniswap v3, so it's needs to be improved for sure. So we are also looking in this direction, and we'll maybe release something more advanced. But yeah, it was really great idea. Other people?
Yeah, I'm gonna chime in on that. Yeah, kind of agree with Sergej. Like, Uniswap v3 is a great innovation. Just want to add, like, because I came from a TradFi background as well. I used to work in commodities and stuff. So, you know, I've seen different products across different asset classes and stuff. And I think DeFi started off as more or less, I think it's safe to say it was kind of like grassroots kind of retail kind of movement, right? It's like driven by retail money, you know, as it grew and stuff. And now it's getting into the limelight. You know, you have like institutions coming on and all that with, you know, Aave having his permission pools and things like that, right? So, in my opinion, right, for DeFi to go into the next level of growth, obviously it has to grow up a little bit. And, you know, those protocols that are sort of heading in that direction or inclined in that direction, in my opinion, have much better, you know, a road ahead of them, right? So for example, you know, you look at stuff like insurance, right? This is something that when you talk about DeFi, you always talk about degens, right? Like everyone just goes to the latest shitcoin or whatever, right? But the idea is that, you know, eventually when institutions come on, they're going to care about custodial risk, they're going to care about insurance, they're going to care about all this stuff, right? So, you know, infrastructure, even something like Nexus Mutual, you know, it's not that I'm advocating any project specifically, but, you know, this is one of the sectors that can help the entire sector to grow up in a sense. And that's why I'm bullish in this area. Yeah.
Just to add on that, Shane, you know, just an observation. If you look at the total size of the so-called insurance market, including OPIN and other ones, right, it is incredibly small. You're absolutely right. You know, and a reinsurance typically is a very, very, very large space. In my past life, I was involved in building one of the reinsurance hubs. So I kind of understand how this normally works, and that part of the market clearly hasn't grown bigger. And this goes back to what Aaron was saying, like, you know, increasing the market size in that sense will increase the sizes of yield or chances of yield, because it's like, you know, if the area is smaller, then, you know, if you divide that up, it will be very small fractions. If you have a larger area, you know, there's more chance that you can have a fairer share of the area in that sense. Whether it will be fairer or not, I don't know, but that's what I think will happen.
One things I would like to bring out in that part about innovating and kind of what helps to add maturity to the market space or DeFi is the principle of correlation. And if I'm a large corporation, or I've got, you know, an insurance company or whatever asset class I'm in, or commodities, or whatever the real world product is, the first thing I always do to establish, can I operate in this space, is I look for what is my correlation to safety, or to you know, to eliminate risk, right? Because the first part is people are not going into this and saying, hey, I'm going to put everything on 21 and spin the roulette wheel, right? When you've got billions of dollars at risk, the first thing you do is figure out, how do I get to safety if it all goes wrong? And currently in cryptocurrency, there is no natural hedge. There's no correlation, right? So these assets, when you create a new cryptocurrency, the first thing you should be starting with is actually safety. All cryptocurrencies are emitted on the other side. They come out as risk. So the next level of maturity and growth around DeFi spaces to actually have assets that are correlated to safety first, so that mature spaces can find safety in a trade. Now they can correlate risk to the other side of the transaction. Those are some of the things that we're doing at SmartFi. And I just want to bring that out, that until the pie gets bigger as a whole, in fact, you can't get the pie bigger as a whole until you have a correlation, a directly correlated hedge. I mean, that's rule 101 for a hedge fund. Where's my safety? Now I can go out and find outsized returns and maximize returns related to the risk of that side of the trade, because I can take the other side and assume risk.
So there's a few places that I would recommend right now to go and get yield. Like if you're the things like Uniswap v3 that Sergej was saying is like, it is a little bit complicated to use, but there's a new generation of smart contracts that you can put money into that will programmatically allocate your capital to different yield opportunities depending on what's available. So you can still be a relatively passive capital provider. So Harvest Finance is one that I think, like, these are really high risk, so I'm not recommending these to anyone whose risk tolerance is not super high, but Harvest Finance is really interesting. It allows you it has its own Uniswap v3 liquidity provision rule sets, and so it gets around this complexity of having to do between boundaries. Alpha Homura was also really interesting. They have a programmatic way of allocating capital between different yield opportunities that are available in the space. And I think this is going to increase. You're going to see more sophisticated, essentially almost fund management-like instruments that have a set of simple algorithms that then will allocate your capital within the DeFi space. I also think that we're going to see, probably in the next 6 to 9 months, there's going to be more decentralized derivatives. So you're going to see things like Potion.finance and Perp and DYDX and products like this that are going to increase the asset base that you can get exposure to. Synthetics started off with being able to do natural hedges where you can essentially do a mirrored asset, so you can have Bitcoin that when Bitcoin goes down, you go up. So the ability to create hedges in crypto have been around for a while. They're not very capital efficient. They're getting better. But I think that the asset base of DeFi will increase massively over the next 6 to 9 to 12 months without actually needing to bring any representative assets on ledger. It will just be derivatives and derivative instruments. And that will see the next level of sophistication and also the next level of hedging, as well as the next yield opportunities for capital providers.
Yeah, Piers, just wanted to be sure I add one line to that. So I see the evolution of DeFi as being a slow one in some sense. And so it's sudden surges. So a surge comes in when there's enough of market arbitrage that exists, because either some knowledge arbitrage or some sort of a technology arbitrage, what you're kind of describing of rebalancing algorithms, is kind of in my head like a technology arbitrage. And even though that exists in the traditional trade finance, the sophistication of most of the models are, I would say, on the lower end. So as somebody in different parts of the time actually building strategies for hedge funds, if I compare, what most of strategies that everybody does on the other side of the fence and to DeFi, I think there is still a delta. And when that delta becomes very small, then we will have a very, a very balanced, that's my word I would use, a very balanced situation. So until then, there'll be continuous innovation and we will be getting more and more. And once there is enough of alpha on this side of the fence and that yield to be gotten, it will definitely attract, other assets into crypto. There's enough of assets to actually have derivatives and other things. And derivatives essentially means you can have secondary derivatives, and that's a scheme that is risky, but that's generally how very large markets are built.
Great. And we just have one audience question, and then I think we can wrap it up. An audience member asked, do the speakers think the wallet segment will catch up? Is there a reason why it hasn't yet?
Can I give it a go?
Yeah.
So the thing with the wallet is from the start, essentially wallets didn't actually make any money in that sense. It's like, there has to be some revenue that comes out of a wallet in that sense. But a whole bunch of wallets now have actually changed their strategies. So they've actually integrated themselves with products. So from the wallet, they could actually do trades. And what that implies is a wallet actually almost has a vault. And because, crypto is being deployed in the vault and the vault is generating some yield, this is actually helping the wallet companies have natural growth. Because until now, you can have a whole bunch of very interesting wallets, but because there was no, revenue being generated, there was no hope for an average wallet company to grow on its own. Now that we actually have a chance, you can look at Argent, you can look at a whole bunch of wallets, and each of those wallets have actually done integration with Dexus or other protocols in that sense. So literally now they could actually have a small fraction of the value that they create by having assets locked into the wallet, and hence the possibility of growth. I think the wallet companies are most likely going to grow.
I would like to add, I guess there's only one wallet which earns money right now, and really earns. This is MetaMask. MetaMask is using aggregators, also 1inch, yeah, and so we pay for the servers. We have like 350 servers, each one 64 CPU cores. So if you would run it in the cloud, it would cost $1 million a month for us. It's cheaper for us because we have dedicated hardware. But so 1inch is not charging anything on top, yeah. And MetaMask charges fee on top and earns like 20 minutes a month. So actually, I guess MetaMask have did a great job to just use existing products, existing protocols and services, and just make money without huge effort. For sure, they are paid a lot in the beginning. They paid a lot for Infura, free service, also MetaMask itself. And I see a good opportunity that they would improve MetaMask a lot in the next time. I wish it, because it's terrible to use still. And also on our side, we released our own wallet because we didn't find the right wallet out there. This slogan sounds similar to the Ferdinand Porsche. He didn't find the right car. He built his own car. Similar here, because we take security we see security as very important. And if you sign a transaction using hex data and you sign this transaction, this is not user friendly. So Nexus Mutual guy lost a lot of money because he signed a manipulated transaction. So, and in our case, we parse the call data and show, for example, if you swap in 1inch, we show, you can also sign on the Apple Watch. Yeah, you get the text. You swap one Ethereum to 2000 USDC, and the transaction cost is this. And if you sign it, then this is what you execute, not more, not less. And we need more of this. We need more more user-friendly wallets out there.
I would echo that. I mean, that's one of the things that we've done at SmartFi is that instead of creating all of our own technology, we go out and find vendors that are doing something interesting in the space and partner with them. So we've partnered with a company called Komodo. That's a community that built a blockchain, 4 years ago, and we've basically helped take their product, and they've built a blockchain interoperable DEX. That's a non-custodial wallet that you download to your desktop. It'll be available in a mobile app here shortly, but it has trading protocols inside it. And then we plan to innovate around derivatives inside of that wallet and other opportunities, both our lending protocols and all of our other processes, our DeFi processes inside that wallet, so that you don't have to custody your assets with anybody. You could do it yourself. So that's happening. It's taking place. It's available now. So those are the things that are maturing the space.
It seemed like the question was also geared towards the institutional side. So the corporations, the companies that have all of these regulations to follow, it's very difficult for them to really get into the space in a big way. partly due to the wallet kind of not being able to be at the level that they need it to be. But it seems like the space is developing quickly.
They need something that's SOC 1, SOC 2 compliant, and there's really nothing like that out there. We use a wallet called Firebox. A lot of institutional players use that kind of a wallet or other institutional wallets. But it'll get there. It'll eventually be able to be audited and compliant with different regulations. So I think it's just a matter of time.
Yeah, just to add to that, Firebox actually had some challenges. Without going into detail, you can find that. So, cryptography and implementation of things haven't really caught up. So this is, again, something I generally say. Traditional finance, I've been in traditional finance before, and I've been in crypto for like 20 years. So cryptography, not crypto, crypto like close to 10, cryptography like 20 odd years. So the lessons learned in the traditional world is not really followed up, and mostly processes. And this case of Firebox is pretty much a case of, processes not being followed, and institutions can't really, take up things and take a very large risk. And, that's when that all improves, I believe, the market will be much larger. And the larger the market, we will have a much better chance of having better yields, I guess. Fingers crossed.
I think there's wallets. There's a bunch of things that are stopping wallets. The security is one side of it. There's also like the interfaces to decentralized finance applications. There's not really any standardization to that. Everyone builds their own sort of way in which you actually have to talk to the different DeFi applications, which makes it very difficult to create standardized interfaces in wallets. And so, MetaMask does suck, but it is actually quite a functional way of interfacing, and custodians are a bit behind that also because they are custodians, and so they have another set of rules where they're not sure if they're now brokers of financial products. So there's some reg stuff that's also in the way. I think that's going to start to be worked out, but until that works out, building the interfaces is difficult. Like if you look at how difficult it has been for Argent to integrate each different protocol, it's had to do it one by one. It hasn't just got, so like the amount of engineering work is very high, and this is why the wallets are being quite slow. And then the regs are very unclear, and that's why they're being slow, because they're being cautious.
Awesome. Great. Thanks everyone for attending this panel, Maximizing Crypto Earnings with Decentralized Finance. Thank you everyone for your time, for your input. Thanks, everyone.
Thanks.
Cheers, guys.